Welcome to the deep dive. You know, if you've ever felt like your investment decisions are just being outpaced by forces you can't even see, well, you're probably right. Today, we are diving deep into the financial markets, looking squarely at the machines that trade faster than human thought. We're talking algorithmic trading.
Yeah.
And crucially, we're examining the very front line of modern finance, where these systems now have to integrate with things like decentralized ledger technology.
Exactly. We pulled together insights from some foundational texts on automated finance, but also recent reports focusing on the Quant Network. Quant is this really interesting platform trying to solve, frankly, a massive interoperability gap between, traditional institutions in DLT.
Yeah.
So our mission here is to cut through all that complexity, give you a sharp, comprehensive understanding of how these systems work, the risks involved, and really where finance might be headed next.
Right. Let's start with basics, though. We need a definition because that term, algorithmic trading, it gets thrown around a lot. What is it at its core?
Well, algorithmic trading, or AT, it's actually quite simple in concept. It's just executing large orders using automated pre-programmed instructions. These instructions look at variables like price, time, volume, things like that. The main goal isn't always prediction, like guessing the future price. Often it's more about leveraging pure computational speed and precision to execute trades in a way that minimizes market impact, reduces transaction costs, basically overcoming human reaction time limits.
And its dominance now is, well, it's pretty much absolute, isn't it?
Oh, completely. The machines have utterly taken over the high-volume markets.
Yeah.
I mean, just look at the Forex market. A 2019 study showed something like 92% of all trading volume in foreign exchange was done by algorithms, not people. This is how the big players, investment banks, mutual funds, hedge funds, how they manage their liquidity now.
Okay, 92%. That's huge. But that level of automation, it didn't just happen overnight. Let's maybe trace the history a bit. Where did this all start?
Yeah, it started pretty humbly, actually. Back in the early 1970s, the NYSE introduced something called the Designated Order Turnaround System, or DOT. That later got upgraded to Super DOT in 1984. These were essentially just electronic ways to route orders. Then by the 80s, you started seeing program trading really take off. The NYSE defined that as like big block trades, maybe 15 or more stocks worth over $1 million. It let the big institutions efficiently run strategies like index arbitrage.
So early days, it was more like electronic plumbing, just getting orders where they needed to go faster. What were the big market changes that pushed AT from just being electronic to being, well, indispensable?
Good question. There were really two key accelerators, beyond just faster computers, of course. First was the rise of electronic communication networks, ECNs, in the 1990s. These let people trade away from the main exchange floor. Second, this was really crucial, was decimalization back in 2001.
Okay, decimalization. Explain why changing that minimum tick size, the smallest price movement, was such a big deal for algorithms.
Right. Before 2001, the smallest a stock price could move was 1/116th of a dollar. 16 cents, basically. That was a decent gap. Market makers could make a good profit just capturing that spread, that little slice. When decimalization shrunk that minimum move down to just 1 cent, well, the profit margin for human traders just collapsed. To make money, you suddenly had to capture hundreds, maybe thousands of those tiny 1 cent spreads, and you had to do it faster than everyone else. That absolutely required machine speed. And as a side effect, it massively increased market liquidity and overall trading volume.
Okay, so the structure changed, favoring speed. And here's where the tech discussion gets really interesting, I think. Early algorithms, they were based on pretty simple fixed rules, right? Like if a RSI hits 70, sell. Now we're talking about intelligence.
Exactly. We've seen this really pivotal shift towards integrating machine learning, specifically something called deep reinforcement learning, or DRL. Think of the old algorithms like following a fixed paper map. Always turn left here no matter what. DRL is more like using Waze or Google Maps. It learns through millions, even billions of simulated trades. It adapts dynamically to real-time market chaos it's never even encountered before. It's constantly optimizing its path, trying to find the highest reward while managing risk on the fly.
So it's not just following preset rules anymore. It's actively learning the best risk profile for this exact moment.
Precisely. And that makes it way more effective in really volatile conditions, which is exactly where those older static rule systems tend to fall apart. And alongside that, we also see things like directional change, or DC algorithms. What's fascinating about DC is they kind of ignore fixed time intervals. They don't care if it's 3 p.m. or 3.01 p.m. They only trigger based on a natural measurable move in the market, like a clear uptrend starting or a reversal happening. They follow the market's rhythm. And this approach, focusing on the actual market movements, has been shown to be significantly more profitable, especially when things get choppy.
Right. Now let's drill down into the absolute extreme end of this tech. High-frequency trading, HFT. This isn't just fast algorithmic trading. This is like the nanosecond arms race.
Yeah, HFT is defined by that absolute pursuit of speed. We're talking ultra-low latency, usually under a millisecond. It involves co-location, physically putting their servers right inside the same data centers as the stock exchange's computers. And extremely high turnover, very, very short-term investment horizons.
And the dominance here is just staggering. You hear these stats, HFT firms, they make up maybe only 2% of all the firms trading.
Tiny fraction, yeah.
But they account for something like 73% of all U.S. equity trading volume.
It's an incredible figure. And the most famous example, the one everyone quotes, is Virtu Financial. They reported being profitable on 12,277 out of 12,278 trading days over a 5-year period.
Okay, hold on. 12,277 out of 12,278 days. Profitable. That doesn't sound like someone successfully predicting the market every single day. That sounds like they have a sustained operational edge. Is that fair? Is it proof they just have an unfair advantage?
Well, that's the absolute core of the debate, isn't it? HFT success isn't really about predicting where a stock will be next week or even tomorrow. It's much more about exploiting these tiny, fleeting pricing discrepancies that pop up for microseconds, or providing liquidity just a hair faster than anyone else. Their success comes from exploiting the mechanism of the market structure itself, using speed.
Okay, let's unpack how they do that. What are the main strategies these HFT firms use to get that edge?
They generally fall into about 4 main buckets. First, there's market making. This is where they constantly place buy and sell limit orders just around the current market price. They act as liquidity providers, essentially. And their profit comes from capturing that tiny difference between the buying price and the selling price, the bid-ask, spread over and over again, millions of times.
Makes sense. What else?
Second, arbitrage. This is the classic one. The moment a temporary price difference appears for the exact same asset on 2 different markets, say a stock listed in New York and London, the algorithm instantly buys it on the cheaper market and sells it on the more expensive one. Boom. Risk-free profit locked in before a human could even blink. It exploits violations of the law of one price.
Right, pure speed play. And what about handling those huge orders from big institutions?
That brings us to the third bucket. Transaction cost reduction algorithms. These are vital for pension funds, mutual funds, anyone needing to buy or sell massive blocks of stock. Instead of dumping one huge order onto the market, which would immediately push the price against them, these algorithms slice it up. They use strategies like VWAP, volume-weighted average price, or TWAP, time-weighted average price, to feed small pieces of the order into the market strategically throughout the day, trying to be stealthy and minimize disruption.
Okay, and the last one. Finally,
you have mean reversion. This is more of a statistical bet. The idea is that prices sometimes temporarily swing too far away from their long-term average. These algorithms bet that the price will eventually snap back, revert to the mean.
This relentless race for speed, it clearly creates efficiency in some ways, but it also feels like it creates serious ethical and structural headaches. You mentioned that operational edge. What specific tactics really highlight the fairness concerns?
Yeah, the primary ethical issue is simply the unequal playing field, let's be honest. Only the absolute largest financial institutions can afford the millions in co-location fees, the proprietary superfast data feeds. Everything you need to operate at sub-millisecond speed, so it naturally concentrates wealth and power. But beyond just access, the speed itself enables some pretty questionable tactics.
Like spoofing. I've heard that term.
Spoofing is a classic manipulation tactic, yeah. An algorithm places a huge order. It never intends to actually execute, say, a massive bid to buy a stock at $20.10. That huge order makes it look like there's strong buying interest, right? It changes the visible market depth. This misleads other traders. Then the spoofer quickly executes their real, probably smaller, trade at a now artificially better price and instantly cancels that giant fake order. It's basically using speed and computing power to paint a false picture of the market for a split second.
Wow, okay. And, quote, stuffing. That sounds different. Is that about slowing others down?
Exactly. Quote, stuffing is like a denial of service attack on the market data feeds. An algorithm floods the system by rapidly entering and withdrawing hundreds of thousands, maybe millions of orders in a tiny fraction of a second. If you're an HFT firm with your own private, high-capacity connection to the exchange, maybe you can handle that flood of data noise. But your competitors relying on the standard public feeds. They get overwhelmed, their systems lag. It creates artificial latency for them, giving the stuffer an advantage. It's basically weaponizing information flow.
This inherent speed and fragility, It all came to a head in that terrifying event, the 2010 flash crash, didn't it?
Oh, absolutely. That day was a chilling wake-up call. Regulators investigated and confirmed it was triggered by just one single large algorithmic sell order. But what happened next was crucial. Other HFT algorithms reacted instantly, saw the downward pressure, and started pulling their own buy orders, rapidly removing liquidity from the market. This created a feedback loop, accelerating the crash way beyond anything anyone thought possible. The sheer speed turned a dip into a terrifying plunge, and it left everyone asking this profound question: accountability. When automated systems cause a market meltdown like that, who's actually responsible? Is it the programmer who wrote the code, the trading firm that deployed it, the exchange, the regulators trying to oversee systems that evolve faster than they can possibly legislate? It's a huge problem.
Right. The flash crash really showed us that maximizing speed and efficiency could paradoxically lead to peak instability. We basically built markets that were too fast for humans to understand and maybe too fragmented for institutions to effectively control. And that complexity, that fragmentation, it seems like it created a need for a new kind of technology, a translator almost, something to bring structure and maybe compliance back into this digital chaos. Which brings us, I think, to this whole integration race, and specifically the Quant Network.
Exactly. Quant is directly aiming to solve that problem of systemic fragmentation. They use their platform called Overledger. Now, it's really critical to understand. Overledger itself is not a blockchain. Think of it more like a DLT gateway, or maybe the ultimate universal adapter for enterprise financial systems. It's designed to be a network of networks.
So it's like middleware. Let's say a big bank keep its existing heavily regulated legacy systems, but still talk fluently to this new world of blockchains and DLTs.
That's a great way to put it, yeah. It uses a standardized open API framework. This allows it to connect those old legacy systems, various regulated DLTs, think R3 Corda, which banks like, and also public blockchains like Ethereum or Bitcoin, all under one unified structure. The key is it removes the need for banks to build these incredibly complex, bespoke, point-to-point connections every single time they want to interact with a different ledger.
Okay, so it's a translator. And the outcome of this translation capability is something they call MDApps, right? Multi-chain dApps. But how is running an app on, say, 3 different blockchains at once fundamentally different from just using a really good centralized API gateway that connects to everything? Doesn't the underlying complexity of dealing with multiple chains kind of negate the speed benefits we were just talking about with HFT?
That's a really sharp question. The key difference lies in the potential for shared decentralized governance and, crucially, native asset transfer, without using things like risky bridges or wrapped tokens. Overledger aims to allow for true cross-chain logic. The MDApp's core functions can be written to be ledger agnostic, meaning it can manage processes or assets across different chains seamlessly. They also introduced a concept called multi-ledger tokens, or MLTs.
MLTs. Okay, what exactly is an MLT? How does that work?
Think of an MLT as less like a traditional token and more like a digital asset identity tag or a pointer. It allows something like a stable coin, or maybe even a central bank digital currency, a CBDC, to have its ownership changes recorded simultaneously across multiple different systems, say a bank's internal ledger and a public blockchain. And it can do this without actually needing to move the underlying asset itself across risky bridges. It makes secure, compliant asset tracking and transfer between different institutional silos much smoother.
Interesting. Now, for institutions to actually use this Overledger gateway, they need to interact with Quant's native token, QNT. What's its specific function within this whole enterprise setup?
Right, the QNT token has a clear utility role. It acts as the mandatory currency for consuming resources on the Overledger network. So enterprises have to pay in QNT for things like API calls, data access, setting up those gateway connections. And furthermore, the network operators, the entities that run the gateways, manage traffic, ensure security, they have to pay yearly licensing fees, also in QNT. So this design directly links the adoption and usage of the Overledger platform by enterprises to the demand for the QNT token itself.
Okay, that makes sense. And this past year, specifically around September 2025, we saw some pretty major institutional validation points for Quant, didn't we? These seem to confirm that enterprise focus.
Yeah, so September 2025 was huge for them. There were 3 key announcements. First, on September 26th, 6 major UK banks, we're talking HSBC, Barclays, Lloyds, big names, to a JV. They began a live pilot testing tokenized sterling deposits. And they used Quant's core infrastructure for this. The goal is pretty straightforward. Use DLT structure to streamline traditionally slow, cumbersome processes like settling bonds or processing mortgages.
Wow, putting Quant literally inside the UK's core financial plumbing.
Pretty much. Then, just the day before, September 25th, Quant was formally named as a technical partner for the European Central Bank's Digital Euro project, their specific focus: cross-border interoperability. This is massive for regulatory credibility. It signals potential long-term, large-scale demand if the ECB ends up using Overledger to handle transactions between different national central bank systems within the Eurozone.
Huge validation, and their own internal platform launch, QuantNet, that seemed timed to capitalize on this momentum.
Absolutely. QuantNet was launched on September 29th. It's basically positioned as a ready-made platform for banks and institutions. It helps them integrate tokenized assets with their existing legacy systems without needing that incredibly expensive, decade-long IT overhaul that usually scares them off. And the market definitely noticed. QNT saw about a 7% price jump right after that QuantNet announcement, showing investors saw it as a strong confidence signal.
Okay, so strong recent wins. Let's look ahead. What's on the roadmap for the rest of 2025 and into 2026? Where are they headed?
Their roadmap clearly centers around scaling up and enhancing security. It seems broken down into two main phases or concepts: fusion and flow. First up is the Quant Fusion mainnet, which is slated for Q4 2025. This is their layer 2.5 architecture, kind of an interesting layer description. It focuses on combining multi-chain rollups for scalability with advanced privacy tools. The key innovation they're pushing here is achieving secure interoperability between public blockchains and those private permission chains that banks use without relying on external bridges or wrapped tokens. As we mentioned, those are often major security weak points.
Right, avoiding the bridge hacks. And how are they planning to secure this new Fusion network?
That ties into the Trusted Node program, which is also scheduled for Q4 2025. This introduces QNT staking. The idea is to decentralize the validation of transactions happening across the Overledger network and generally secure this new fusion layer through staked QNT. Then looking further out into 2026, the focus shifts to QuantFlow expansion. This is about scaling up their programmable money solutions, things like making cross-border payments faster and cheaper, enabling real-time liquidity management for treasuries. They're planning much deeper integrations with banking systems for this phase.
Okay, so you have this clear tension. On one hand, incredible institutional momentum, major partnerships, significant project milestones coming up. But as you look at the market charts, the short-term sentiment still seems, well, cautious.
Yeah, the market view is definitely mixed right now. You see the price kind of consolidating, currently sitting between technical levels around $57 support and $105 resistance. The institutional news, the ECB partnership, the UK bank pilot, that absolutely fuels long-term bullish optimism. It validates Quant as a serious player, a viable solution for regulated finance. But short-term caution is understandable. These massive enterprise integrations, they take time. It takes time for them to translate into immediate, large-scale, measurable revenue and token demand. It's a long game.
So let's try to wrap this up. What does this all really mean for the bigger picture of finance? We've traced this journey from very early, almost clunky program trading, all the way to today's incredibly complex, specialized, sometimes ethically murky HFT systems. Algorithmic trading brought immense efficiency, yes, but as the flash crash showed us, it also introduced new kinds of systemic volatility and, frankly, uncertainty. Now it feels like the focus is shifting again towards these interoperability platforms like Quant. The goal seems to be imposing structure, compliance, a kind of translation layer across this growing digital divide between old and new finance.
That's a good summary. We've definitely entered what some academics call cyborg finance, right? Where machine logic and human governance are just fundamentally tangled together now. AT drove complexity deep into the market's plumbing, into the mechanisms themselves.
So here's the final thought, the provocative question maybe. If a platform like Quant's Overledger actually succeeds, if it really unifies all these disparate financial systems, TradFi central banks, public blockchains like Ethereum, private enterprise chains like Corda, all under one interoperable roof, will this hyper-interoperability finally deliver on that promise of global financial transparency and efficiency we always hear about? Or will simply connecting all these incredibly complex, fast-moving systems just create a new, even more intricately interconnected financial architecture? One that's potentially so complex and intertwined that it becomes fundamentally impossible for human regulators to fully understand, let alone oversee or contain if something goes wrong. That feels like the big question about systemic risk that this next generation of automated, interconnected finance will ultimately have to answer.